Well, good morning. Welcome to our webinar today on a tax legislation update. A few housekeeping items and we'll jump right into it. You should have a little box in your Zoom there where you can submit questions, so we encourage you to do that. We'll try to address as many of those as we can, and if we don't get to them, we will follow up with you after the webinar. The presentation slides can also be downloaded from the handout section of the webinar control panel, in addition to other helpful materials. For CPE credit, we will have some polling questions we'll launch throughout the webinar, and those will need to be answered in order to receive CPE credit for attending the presentation. So with that, I'd like to welcome my colleagues Jim Brandenburg and Jenny Kramer from both from the great state of Wisconsin, and we'd like to go ahead and get started with our webinar today. So here's our agenda today. We'd like to talk to you about where we're at with the current pending tax legislation. So we'll start off just talking about the partisan reconciliation spending plan called the Build Back Better Act. And, you know, not to refer to any baseball analogies, but it reminds me of the killer bees from the Houston Astros back in the day. So we are getting close to that October timeline when baseball will be on the TV a lot. So I thought I'd throw that in there. The tax provisions in the House Ways and Means proposal, Senate tax plans, and then next steps in Congress rounds out our agenda today. So with that, I'll turn it over to Jim Brandenburg, who will kick us off with the Build Back Better Act.
Good. Thank you, Tom, and good morning, everyone. Thank you all for joining us for our session today. What we'll be addressing today is this, as Tom mentioned, this Build Back Better Act. It's in Congress now, and more specifically, we're going to look at the tax provisions in there. Again, this is this legislation is a partisan individual infrastructure bill that Congress is looking to push. And again, what they're using with it is what they call the reconciliation provisions. Again, that's a separate set of rules that allows them to pass a bill with just a majority of 50 votes in the Senate, not the normal 60 votes. You may recall the American Rescue Plan that was passed earlier this year was done under reconciliation with it. So that's different than there's a separate fiscal infrastructure bill legislation that passed the Senate in August and waiting for action in the House. That was done in a bipartisan manner, not under reconciliation. So again, the reconciliation provisions, we'll talk about that a little bit, again, is what this Build Back Better is going to follow. Next, I'd like to just kind of give just a brief overview of some of the themes that are in this Build Back Better Act here. Again, it's a $3.5 to some say up to potentially $4 trillion spending package. And some of the main themes here, what they're going to be looking at is for families, you know, for education and a family leave plan. There's a lot with energy and climate issues within this package. There's also some other infrastructure and jobs provisions within it, healthcare that they're going to have, an expansion of Medicare, and much, much more. Again, it's a massive bill. At latest count, it's about 2,500 pages. And again, they had input. We're going to look at the Ways and Means Committee, but there was input from 12 committees with it. They provided theirs to the Budget Committee, which kind of gathered all these different proposals that each of the committees put together. They got that together in the middle of September here. And then last Saturday, they actually had a Saturday session where the Budget Committee took those 12 committee proposals, put those together, passed on a party line vote, and now it's awaiting Rules Committee action, which will come at some point. And there may be some other changes to this bill, especially some tax provisions may be in there that may come up before they actually bring it to the floor of the House. So this is just a little background on what's in there. And again, it's a $3.5 trillion proposal as far as the spending. And what we're going to be focusing on today is how that's going to be paid for. We're going to look at some of the actual tax provisions that was in the House Ways and Means proposal that came out just a couple weeks back and that the House Ways and Means Committee dealt with. We're going to look at some of the tax increases for businesses in the states. Tom's going to go through that, and some of the tax hikes for individuals that Jenny will get. I'm going to look at some of the other individual provisions of the social safety net they have, And then we're going to look at some energy provisions, then some real estate proposals that Tom and Jenny will get. So again, our focus today is on some of these tax provisions that are in this House Ways and Means proposal that is moving in the House at this time. So with that, move it over to Tom to take us to the again some of these business and estate items in this House Ways and Means proposal. Tom.
Thanks, Jim. So as Jim said, these are simply proposals. They're proposals from the House Ways and Means Committee. There have been some proposals published by the Senate. So, you know, where these all end up is yet to be seen. What you should know, though, is these concepts probably don't go away, regardless of whether they get into the legislation, you know, that may be passed in the next month or so or not. There's somewhat of a you know, a theme here that we think is going to be part of the tax infrastructure going forward. So remember that for corporations, the Tax Cuts and Jobs Act that former President Trump passed create a flat rate of 21% on C corporations. The new proposal, you may have heard in the media, initially the original proposal had rates going to 28%. And this is, you know, this corporate tax rate, what is being done is we're comparing our corporate rates to other countries and trying to be competitive, and that's originally why the rate came down to 21%, is the argument was the former rates were way too high. So there's somewhat of a middle ground here trying to be reached. And so the new proposal is not a flat rate, it's a progressive rate. So 18% on the first 400,000 of taxable income, and you're going to see that $400,000 number in other places within the presentation. Jenny will talk about some of the individual rate increases, and you'll see that number or close to that number pop up again. So that is one of the themes. And then as we go up the ladder here, 21% on taxable income from 400,001 to 5 million. So a lot of small corporations probably get the similar rate or a lower rate in the case of if taxable income is below $400,000. And then we get into the 26.5% rate for income over 5 million for the corporation. And then if the corporation exceeds 10 million, they lose the lower bracket. So everything's taxed at that highest rate. The personal service corporations are not eligible for these graduated rates. On pass-through entities, one of the proposals that is out there from the House Ways and Means Committee is to allow S corporations that elected S status on or before May 13 of 1996 to convert on a tax-free basis to an LLC or partnership. There's a 2-year period or 2-year window where they propose you could do that. And that's an interesting proposal. And we're not sure where that came from, but it's something to keep an eye on, and it may make sense for certain corporations, S corporations maybe, that are looking at succession or maybe have a lot of property inside of them. That might be an interesting strategy to follow. And then certain individual provisions that Jenny will talk about will increase tax on some of those S corp K1 income, and she'll cover those. Another proposal, which we've seen in both Senate and the House proposals, is to improve taxpayer compliance and to really fund, you know, increase the appropriation for the IRS, almost $80 billion to increase compliance. And specifically in the House Ways and Means proposal, again, not targeting groups under 400,000 of taxable income. So really targeting compliance for higher income, what they consider higher income taxpayers. 157 million is set aside for tax courts specifically. And also, you know, I would mention that we are seeing, and other practitioners seeing, a little bit of an uptick in IRS audits already. So we think this compliance, there's going to be an increase in compliance in one way or another.
Yeah, an interesting item there, Tom or Jim. I know one of our questions that already came in and something talked about often in the news if you're listening, and one of the key items talked about a lot is this sense of banks required to report any transaction over $600 to the IRS. The question came in the format of, do Venmo, PayPal, Etsy, everybody have to report all transactions now? Are either of you able to comment on that a little bit in regards to where that sits with this proposal and what that really means?
Yeah, that's a great question, Jenny, with it. And the administration had initially proposed a $600 threshold for banks to report all those transactions. That did not end up in the Ways and Means package that they introduced when they voted on it a couple weeks ago. But that's still, I guess, under consideration, that they could bring that up later on before this moves ahead, and they could unveil that, or the Senate might want to push that too. So while it wasn't in the Ways and Means one, that could still be brought up with it. There's a number of banks and other groups are trying to push back against that. So we'll just have to see what happens with that.
Well, over the last few years, we've seen as a profession that more and more of the compliance burden with asking our clients, what we have to report, did they file 1099s? More of that compliance burden is being pushed down on the profession. So, if they want, if the goal is to have more compliance, they want to try to beef up the IRS, but they can also push some of that burden down on the preparers, right? The CPA profession and other tax preparers to force that compliance, and that's another example.
Mm-hmm.
And if that happens, that could really increase the amount of work that CPAs have to do in order to reconcile those deposits.
Exactly.
Another provision a proposal is to reduce the deduction for both of these, what I will call deductions for international sales. There's the foreign derived intangible income, which is, the proposal is to reduce that deduction to 21.875%. That is a reduction of what it is currently. So the current effect, and if you consider the 26.5% corporate rate, it works out to about a 20% reduction of the taxable income. So, and then on the GILTI, global intangible tax income, again, reduce that deduction will increase the tax on those foreign sales. So that's another proposal that's out there. One of the things that's talked about a lot too is with a lot of private equity firms will have what's called carried interest, and it's it's partnership interest held in connection with the performance of services, and they're able to get long-term capital gain on that carried interest if it's held for at least 3 years. The current proposal from the House Ways and Means Committee is to extend that holding period to 5 years, and there are some exceptions to that 5-year rule. Of course, if AGI is under 400,000, and then also certain real property trades or businesses are also excluded. Some other business provisions that are in the proposal, and there's several. We're trying to highlight ones we think are of greatest interest to the audience. The Work Opportunity Tax Credit is a really nice credit for hiring folks from these targeted groups. Pretty good size increases being proposed, 50% of the first 10,000 of wages, and that also applies. That's in year 1 and also extends to year 2. So for the first 2 years, if you hire somebody from one of those targeted groups, you could get up to a $5,000 credit. It's about double what it is now, right? And it's only for the first year currently. So another change is the small business. There is a small business stock opportunity if you own small business stock and it qualifies under what's called Section 1202 of the tax code. You could be eligible for a 75 to 100% exclusion on the taxable gain on the sale of that stock. You have to kind of go through the eligibility requirements on that. But under this proposal, anyone with AGI over 400,000, the gain exclusion would be limited to 50%. So again, reducing it for those with income over 400,000. And the effective date on that is proposed to be as of the date this proposal was released. And lastly, another somewhat, we see this strategy where we call them self-directed IRAs, where business owners may want to put an investment, a private investment inside of a self-directed IRA. The IRS is kind of creating more limitations on that, where now if the IRA owner has greater than 10% ownership interest in that investment, then it's a prohibited transaction and actually violates the IRA. So it's a pretty serious matter. So be careful with those. On to some estate changes. This is a pretty significant change. Grantor trusts are fairly popular in estate planning. Allows the grantor that funds the trust to get maybe a highly appreciating asset outside of their estate, but they continue to pay tax on it. The proposal would make that, and that's a tax-free transaction right now. The proposal from the House Ways and Means Committee would force the taxpayer to pay tax on the gain on that asset. That would trigger a gain and a taxable gain. And then the other part of this is it's not excluded from their estate. So it really kind of, that strategy really would go away if this particular proposal were enacted into law. Unified credit on estate and gift taxes would go back down to the 5 million adjusted for inflation, which probably puts it at somewhere around 5.8 million. But it would revert back. It would basically accelerate what's in the law currently, and that's supposed to sunset at the end of 2025. But that would essentially accelerate that back to 2022. And lastly, another pretty significant change. A popular strategy is to take valuation discounts when we have clients that set up family limited partnerships or LLCs, and they contribute assets into that LLC, and then there's some discounts taken as they gift some of those LLC interests potentially to family members. If those are non-business assets, such as publicly traded stocks or bonds or those types of passive investments, this proposal would not allow for any kind of valuation discount to be taken on those assets. So again, sort of taking away another fairly popular planning technique. Okay, and I think we're on to our first polling question. So give you a minute. Will the reconciliation package Build Back Better Act be enacted this year? Yes or no? Good question.
Yeah, that's a good question, especially coming off of the topics you just talked on there, Tom. While everybody's answering, it's really hard, I know, to be able to look ahead and plan when we don't know what's going to be enacted here, but especially on those estate tax items, I think the general theme is something's going to happen now or ultimately with that phase out in the future. So it's a good thing to be talking about with your advisors, especially if your estate is over 5 million, to potentially put into effect some items that could help you in the long run there.
Yeah, we'll give you just one more second here and we'll see what the results are, and then we'll move on to our next section. Okay, it's about 50-50. A little 53% say yes, there will be an act that will be passed. 47% say no. I'm about where everybody else is at. I really don't know. There seems to be a lot of disagreement on what should or shouldn't be in the size of this package. So
perfect. Okay, well, I'm going
Result,
to
that's good.
I'm going to jump in now on covering the tax increases that would be imposed on individual income taxpayers under the House Ways and Means proposal again. And this would encompass business income from pass-through entities, from those flow-through businesses, which ultimately is taxed at the individual taxpayer level. So you're going to see themes of, both from your business and how that impacts when you get down to the individual income tax return. One of the most highly anticipated and closely watched items is the preferential tax rate for long-term capital gains and qualified dividends. And these might arise not only from investments in publicly traded stock, but also if you are selling business assets for gains that are categorized capital gain or 1231 gain. So that could be very significant upon the sale of a business or a significant amount of assets in your business. So this is currently one item in the proposal that does have an effective date that causes implications before the end of the year, December 31st. As you'll see going forward, and the items Tom talked about, a lot of this is set to be effective for tax years after December 31st. But essentially what we're looking at is moving that top capital gains tax rate for individuals, estates, and trusts from its current level of 20% up to 25%. So not as far as the ordinary income tax rates, which we'll touch on momentarily, and that's kind of what was talked about in prior proposals, but somewhat middle ground, from that original Biden administration framework suggestion. So again, September 13th is really the date in this proposal that is of importance. As I mentioned, this would actually be that triggering date, bifurcating date, as to gains prior to that date would be still at the 20% rate. Gains after that date would be at the higher 25% if you qualify in those brackets. So something to be aware of and be certainly conscious of right now. Again, still a proposal, but we do have this one case where we have a date already established if this were to pass. The one item that does go into effect at the end of the year for 2022 is actually what position where that top rate applies. And you'll see that when I talk about the ordinary income tax rate increases here in a moment. So from the standpoint of ordinary income tax rates, outside of capital gains, we're looking at moving from a top individual, estate, or trust income tax rate, moving from 37% up to 39.6%. And that is kind of on par with talks that we had seen before this release. So probably the more impactful change as part of this is how much lower that highest tax rate would apply at. Tom mentioned it before, we've heard it in the news, that $400,000 of income level is really that triggering point that Biden has established. And so you'll see that highest tax rate now, starting in 2022, would kick in at $400,000 for single filers, $450,000 for those married filing jointly. Again, that would be effective starting in 2022. So in and of itself, not a huge jump from 37 to 39.6, but now I'm going to layer in. We're going to see some layering of a lot of different taxes that suddenly become applicable. And one of those here is that net investment income tax. So this was first established way back in 2013 via the 2012 Patient Protection and Affordable Care Act. However, in its current state, and has it originally applied, it only applies to investment income and income that's more passive in nature to the recipient. But this proposal, what it significantly does is expands that applicability to include ordinary trade or business income, even for those who do materially participate in their business. So this would be your active business owners. So that's a big item for business owners here. That's adding on another 3.8% on top of your ordinary income tax rates. And that's going to apply if your income is over $500,000 for married filing jointly. Again, $400,000 for that single area. So essentially, the only income that now would be kind of excluded and off the table for this extra 3.8% is income generated from a qualified retirement plan distribution. Technically, essentially, any wages or subject to FICA or self-employment taxes also would not be subject to this because they're kind of already getting that in once you're at certain income levels, an extra FICA and self-employment tax on those items. So a significant item, I think, for business owners, again, active business owners in 2022. And then an additional layer, if you get to that point, is a new surcharge that would be imposed on income in excess of $5 million. And this does not take into account or bifurcate or look at what the character of that income is. So whether, it's at your adjusted gross income, once it reaches $5 million, all of the income in excess of that, no matter what its character is, would be subject to this extra 3% surcharge. So I think we're going to see this applying again, probably in situations more so when somebody's having a significant income event, such as a sale of a business. And there are strategies that can be deployed then, when we watch for that. Is there ways to spread out that income over a few years so that you're not reaching over that $5 million threshold and triggering this? But, as we can kind of see here, as I've laid out, you put all of those together, and while we have a top capital gains rate of maybe 25% and the ordinary income tax rate at 39.6%, you're going to likely have the new applicable 3.8%, and in a significant year, you're going to tack on another 3%. So I've laid out there, you really could effectively have a capital gains rate, top rate of 31.8%, and an ordinary income tax rate of 46.4% if you're reaching each of these thresholds. So it really does kind of sneak up on you now. And just to throw one more thing in there, you might be saying, okay, fine, the top tax rate is 39.6, but as a qualified business, I benefit from that 20% qualified business income deduction that was part of the Tax Cuts and Jobs Act. So my tax rate on my business income is really only 30%. So that, that always helps a lot. Now it's going to be, still less than 32%. Well, there is some restrictions on this qualified business income deduction in the proposal as well. Now, not as harsh as originally suggested, but a limitation would kick in when you have an excess of $2.5 million of qualified business income. So it's written in a way that says your qualified business income deduction would be limited to $500,000. Or more significantly, and we're going to see this in a few areas, is if you are an estate or trust, and that kicks in at only $50,000 of qualified business income. And essentially, actually, I want to go back, and I forgot to mention that on that 3% surcharge, also it's estates and trusts where that really hits hard soon. It's only once you exceed $100,000 of income. So really have to be careful if this goes into effect, and understanding the levels of income that are flowing to estates and trusts, and any planning that can be done to potentially mitigate those extra taxes when that comes into effect. One more item here in regards to, again, an item that was brought in by the Tax Cuts and Jobs Act. It was to preclude the ability to use losses from a business to offset other types of income in any individual tax year. So what this proposal, as part of this House Ways and Means proposal, does is makes that permanent. That was kind of a temporary measure in those scoring before. And essentially just keep in mind that it's going to limit your ability to utilize losses to the extent you have income at certain levels. And then finally, I just want to touch on some IRA restrictions. Again, these items kind of hit the news a little bit more too. One item, a few items just for really when you in aggregate have significantly large retirement accounts. Again, in aggregate, these are apply to those that have over $10 million. They're basically going to restrict your ability to further contribute to, IRAs or Roth IRAs, those retirement accounts, if you have an aggregate accounts that exceed $10 million and your income is over those, $400,000, $450,000 thresholds. It also then increases, you have those accounts over $10 million in total, they're going to require you to do some significantly increased required minimum distributions to kind of get that balance down. So again, if you're considered in that high income over 400,000 level, have these $10 million of aggregate assets in retirement accounts, they're going to require you to withdraw a significant amount to get you back down under the 10 million.
Hey,
And
Jenny,
then
we had a question here, just real quick, thought it'd be a good time to put it in there. Is
Yep.
the QBI determined at the shareholder member level or at the LLC level?
Sure. That those dollar restrictions would be at the individual level, is my understanding.
Right.
And then the last item on the IRAs, Roth IRAs, some of you might be familiar with what's called the backdoor Roth IRA contribution. Once your income is over a certain level, you're not technically eligible to contribute to a Roth IRA. However, there's always been this kind of backdoor ability to contribute by first making a contribution to a traditional IRA with after-tax dollars, and then actually being able to roll that right over, convert it into a Roth IRA. So they're proposing putting a restriction on that you no longer can do that. You can't contribute after-tax dollars and then just roll them over. And then interestingly enough, something to keep in mind, I guess, planning over the next 10-year span would be, right now you just always do have the ability to roll assets into a Roth IRA, which is often an income triggering event. You're going to pay tax on those dollars to get them into the Roth IRA, but you're doing that with the intention that you're betting you're going to pay a tax at a lower tax rate than maybe you would in the future. And this is kind of putting a sunset on that, at least to make you think about it, and to accelerate maybe some of those conversions for extra tax dollars for the government. So they put a sunset on that at 2031 potentially in this proposal. So with that, I am going to hand it back over to Jim, who's going to start covering some of the tax provisions that these tax increases we've been discussing are planning to fund. I guess we'd look at it that way.
All right, thanks, Jenny. Yes, what we're looking at now is a different part of the Ways and Means proposal, and it's actually some tax incentives or credits that are included in the overall package here, this reconciliation package. And the first deals with an extension modification of the child tax credit. Many of you are familiar with the rescue plan this year, increased the amount of the child tax credit to $3,000 and $3,600 for those under age 6. But that only was going to apply for 2021. So this is going to be extended that through 2022. So be aware of that. And the second thing that they did with this rescue plan was to start paying these child tax credits on a monthly basis. And again, that just started in July. So it's only going to be half a year here in 2021. They're going to do that obviously for the full 2022 year with it. So something to be aware of. The other thing that gets adjusted for at the end of the year, when you look at your actual income to see how much credit that you should be entitled to based on, because those advance payments are going to be based on your prior year income. One thing they're going to change for the 2022, these advance payments is they'll look at either your 2022 or 2021 income, and if that's lower, adjust that. So that's a favorable provision that they would be putting in. And the last thing they're going to do is change is previously you had to provide a Social Security number for your child dependents to get this credit. Now they're also going to allow a taxpayer identification number, a TIN, for that. So another change that they're proposing here. Next thing is, this is somewhat similar to these advance payments, but it's actually going to be referred to as a different one. It's called this new monthly refundable child tax credit. And it's going to replace the current credit. It's really going to be a monthly payment that they're going to make, again, starting in 2023 with it. Again, it's $250 per specified child, or $300 if the child is under age 6. And there's a key term in here, and again, it's going to be different than the child tax credit that you've had before. They're going to look at this, what they refer to throughout this is this presumptive eligibility. And once you've established that presumptive eligibility, you're going to be able to claim this credit, and it won't be able to be recaptured unless there's some type of fraud involved with it. And then they have a new definition. We'll talk to you a bit as to who do you get this for, a specified child. So they're kind of changing the definition as to who you get this credit for. There is a phase out with this that you're going to get, and but they look at the current year plus the 2 prior years, and if those are lower, you get that. So they're kind of giving you the benefit of the doubt that if your income fluctuates, they're going to pick the lowest year to try to maximize the amount of this monthly credit. Specified child here, again, they list some of the provisions with it, but it's not just as you have now. You've got a child in a family. It could be, they're going to look at where they spend most of their time and who's providing most of the care for that. So it's going to be a different definition that you're going to have to go through with it and try to determine who you can claim this for here. So there's a lot more that's written in some of the materials. If you want to look in there in the subtitle H, where it has some of the details with it, you can kind of look at what's included for the specified child and what are some of the provisions for this facts and circumstances as who's providing that care, who can get this credit then. Another thing that they're looking to change, again, this was also changed by the American Rescue Plan earlier this year, is the child tax credit. Again, it's was expanded to up to 50% of your eligible expenses, up to $8,000, so it's a $4,000 credit per child, or if you have 2 or more, it's a $16,000 or $8,000 credit. That only applied for 2021. This proposal would make this permanent, so that would be a much higher child tax credit that you'd be entitled to going forward from 2022 forward. They also increased the dependent care assistance that would go up to $10,500 per year. That would also be made permanent. There'd be new payroll tax credit for child care workers that would be provided. Again, working in as a child care worker, you're going to get this. This would be eligible for the employer who hires the child care workers. Again, it's up to wages up to $2,500 per employee in a quarter. So that's something to be aware of if that goes ahead. That starts in 2022. And there's another credit here too for a caregiver. So if you're providing care for certain individuals, you can get a credit up to $4,000 of your expenses, a 50% credit. But there's a phase out with it at $75,000. So if you're providing that care, you may get a credit, but watch this limitation. Again, that would start in 2022, and you can't pay a related family member to qualify for that. So something to be aware of here as we move forward. Another change, the earned income tax credit was expanded with that American Rescue Plan. Again, just for 2021, that's going to continue in 2022. There were also some changes for some health credits. There's a premium assistance credit that the Rescue Plan did that applied just for 2021. That's going to apply in 2022 with it again, and make that permanent with it. And then there's also a health coverage tax credit. They're increasing the percentage on that, and that's going up to 80% from 72.5%. Again, that's going to be made permanent starting in 2022. A new credit, a tax credit for you to be aware of. Again, if this legislation moves forward, it's a general business credit that you can get. And instead of getting just a charitable contribution deduction, what you'd be entitled to is a credit, up to a 40% credit for cash contributions that you make to qualifying universities that are going to use that for research infrastructure at those universities. So again, we listed on here as what a qualifying project is. Again, it's going to be some large public universities that have some research facilities. You're actually going to be able to help fund that by making these contributions to those universities, and you get a 40% tax credit. So you don't get the deduction, you get a credit. So depending on what tax bracket you're in, this may be something that is beneficial for you. Again, and there also is going to be a disclosure of the donors to the university who make those contributions. So something to be aware of. And again, all these ones, if these do become enacted, you're going to have to find out some of the specifics with it. And obviously the IRS will have to issue some regulations and guidance on it. Last couple items just to point out here for the safety net. There's an excise tax for investment income in college university. It's at 1.4%. That would get phased down under this bill. Pell Grants, anybody receives Pell Grants, those under the proposal would be able to exclude those from income with it, the provision for that. And last, there's an American Opportunity Tax Credit, again, that individuals are paying for education courses. In the past, you have not been able to get that credit if you had a drug conviction for possession or distribution. That disallowance would be taken away by this bill here, so that they wouldn't have that. You'd still be able to get the credit in that case. So again, those are just some of the individual provisions, selected ones that we covered. Let's go to our next polling question here now.
All right. Thanks, Jim. So what will the top tax rate be for capital gains at the end of 2021? So no change, 25, 30, 39.6, none of the above. So we've got competing proposals out there, so we have to wait and see. So interested in seeing what everybody thinks on that. Give you just another 10 seconds here to vote. All right. Okay, well, sort of a mixed bag here. 23% say no change, and 25%, which is the current proposal we're talking about today, is the majority of folks, 52%. So we still don't know for sure, but the current proposal is certainly better than what, as Jenny said, the moving it up to the ordinary rate bracket. So. Okay, I'm going to talk just briefly about a few energy items. You know, again, thinking about themes here, we see a lot of tax credits and incentives, and in some cases penalties for using fossil fuels and businesses that are not following sustainable practices. So the way the proposal's written currently, the energy measures, there's sort of two tiers, and there's a base rate incentive and a bonus rate incentive, and the base rate incentive for some of these energy measures is pretty significantly lower than the bonus rate, generally about 20%. So, and it all goes back to prevailing wage and apprenticeship and using apprentices and so forth. That's kind of built in, and part of that, I think, is that over the years, the trade unions and labor unions have really depleted their workforce. And so I think this is partly to try to encourage, using union labor. You'll see this in some of the following slides as we lay out some of these measures. So the energy credit, extended and modified, you can claim a tax credit for the cost of qualified energy property. Again, base credit rate is 6% on qualified energy property, and bonus rate 30%. So quite a bit higher. New technologies for energy credit, technologies like storage technology and biogas and microgrid type, technology. There's going to be credits for those. Elective payments for energy, property, and electricity produced from renewable resources versus, fossil fuels. That's another credit, and then an investment credit for electric transmission property. Again, 6% or 30% on the bonus rate. And then there's an extension of some excise tax credits related to alternative fuels. A lot of biodiesel, credits for biodiesel here, that extends through 2031. Non-business energy property credit, again, increasing it from 10% to 30%, and there's a $1,200 limitation on that. Enhanced energy efficiency commercial building deduction, we've Section 179D is currently in place, and there's going to be an enhancement to that to really encourage folks to install more energy efficient or more green sort of technology. And then an extension enhancement of energy efficient home credit, $2,500 per home. That's under code section 45L, and that's an enhancement of the current level, which I think is either $1,000 or $2,000. I can't recall exactly. So, more credit there. And then income exclusion for conservation subsidies. If you're doing water conservation or stormwater management, that income is excluded, related to some of those sustainable practices. And then refundable new qualified plug-in electric drive motor vehicle credit for individuals. That would be a heck of an acronym, by the way, if we could figure one out. You can see that there's credits there, and they're limited. Some of the larger vehicles there's limitations on those. And then the bicycle reinstatement of expansion of the fringe benefit for bicycle commuting is back, and there's a credit for certain new electric bicycles that's being proposed. And then lastly, the reinstatement of the Superfund, which helps clean up hazardous waste sites. So those are some of the energy proposals that are out there currently.
Thanks, Tom. I'm going to cover briefly just a couple of real estate specific measures, again, that are kind of targeted here to be use of these funds, cause enhanced credits, et cetera. And then Jim's going to bring us home with certainly where we stand and kind of the next step in this whole legislative process. So just briefly, some of specific real estate measures that we see in this House Ways and Means proposal would be, one, a permanent extension of the new markets tax credit. This credit has been around for some time, and if you're developing potentially distressed communities, this is a form of financing that you want to be looking into. But that's just going to make that credit more known commodity, hopefully, and make sure that it stays around permanently. Paired with also enhanced rehabilitation tax credit for a few years or permanently in more rural areas. And this is basically a tax incentive targeted at preserving historic properties. So again, just getting funding into places that they think are going to help in communities that are either distressed or in historic areas, properties that wanting to keep around. It makes it easier to qualify for some of the standards. And so keep this in mind when maybe doing some type of renovation project. A new credit then that would be available is targeted at, I think I skipped past it here, in neighborhood homes. Oh, here it is. The neighborhood homes tax credit, and that would be administered through a state program, must be owner occupied, and the homeowner must be below a certain income level. So it would be important, I think, for real estate agents and contractors who work in these areas to be educated on this credit if it does come about, and to help potential homebuyers be aware of and maybe realize the potential of this credit available for those who are able to kind of rehabilitate a deteriorated home in a distressed neighborhood. So again, some real estate specific measures to kind of keep funding in targeted areas that seem to be of importance to the government. So we're going to do one last polling question and then have Jim kind of bring us home with the political outlook here.
Okay, if the reconciliation package is enacted in 2021, will you reach out to your tax advisor with guidance with tax planning? Based on what you've seen today, in terms of some of the proposals that are out there, just curious how many folks believe they'll be affected enough, either at a business level or an individual level, to kind of reinforce doing some tax planning. All right, we'll close it here in about 5 seconds. If you having a hard time making a decision, we should probably play some Jeopardy music while those are going. Yes, so most folks see this as affecting them, I think, pretty significantly. I agree with that. We've already seen that with some of our clients, and just kind of walking through, as Jenny aptly put, layering in some of the tax increases, you start to realize the impact. So I sort of agree with the consensus of the group here. So I think Jim's going to cover Senate tax plans, Jim.
Okay, thanks, Tom. Thanks, Jenny, for your discussion here. We're looking at now, again, what we spent the good part of the discussion here earlier was going through this House Ways and Means proposal and some of the changes, both for individual, for business, and also some of the individual incentives, energy changes. Now we're going to look at is what's the Senate going to do with this? And again, the Senate counterpart is the Senate Finance Committee, and Chairman Wyden has not formally released his plan, and he is in regular contact with the House Chairman Neal on this House package. But again, the Senate has a few different ideas that they may include with it. So Wyden's package, when it is released, may be similar, but not necessarily identical to what's in the House Ways and Means proposal. He is not going to have hearings. Again, the Ways and Means Committee, when they introduced that, on the 13th, they had committee hearings with it. They had some votes on it and some public discussion with it. Wyden does not plan to do that. When he unveils his package, it's going to go directly to the Senate floor. At least that's what the consensus is at this point. What Wyden has mentioned, he's not going to have hearings for that. So since you're not going to have hearings with it, he hasn't released it yet. What might be in that plan here? And the next slide here, what we'll look at is here's some of the things that Wyden has introduced this year earlier, some separate proposals. So anytime the chairman of the committee, especially a tax committee, releases a bill, it's something to keep an eye on. So even if it's not enacted at that point or have hearings on it right away, it may eventually find its way into legislation. So here's some of the ones. We've talked on a few of these. There was an Energy Act, there's a Small Business Fairness Act, which, Jenny talked about the 20% deduction for this qualified business income. Again, Wyden's proposal in the Senate would be much different from that. Once you're over $400,000, you would lose this deduction. So a different format that he's considering. He's got a proposal to cut back on derivatives, carried interest that Tom had talked about. He would have a proposal with that. It may not be exactly what the Ways and Means, but he's looking to curb carried interest. One of the things that is interesting is that he had, this is just a couple weeks back, he had draft legislation which rewrote or would rewrite a good part of subchapter K, which is all the partnership provisions. And again, that may end up in this bill as well. Again, significant changes in partnerships. And I think Tom talked about that before, about the special provision, the House Ways and Means going from an S Corp to a partnership that's available, again, if you meet that requirement back in 96 with that. Before you go ahead with that, if this partnership, one of these partnership provisions ended up in the final bill, you'd want to look at that too to see if it made sense with some of the changes they're going to do in partnerships. Large IRAs that that Jenny talked about. Wyden has not a formal bill, but has talked about putting some curbs in on that, so something to see. And even this week, he introduced a bill on unemployment insurance. So any one of these or a combination of these could end up in the Senate bill as well. And the next slide, just a couple things that Wyden has talked about, this last year, or even going back before that. Some things that may end up in there. Stock buyback excise tax that they would include. Again, that would just be on public companies. A corporate AMT, again, the Tax Cut and Jobs Act got rid of the corporate AMT. Wyden may bring that back at a 15% rate based on book income. So something to keep an eye on. Limiting a compensation deduction to $1 million. The capital gain tax we talked about that Jenny went through is at 25%. Wyden has sometimes talked about getting that to ordinary income. So we'll have to see if he and his bill would also be at 25% or pushing up toward the 39.6%. One thing that had been talked about this year is to trigger capital gains at death. Many of you know that you get a step up in basis under current law. Some have said that, well, we should trigger those gains at death. Wyden has talked about that, but maybe giving a $5 million or $10 million for a couple exemption, and then also a family farm exemption of $25 million. But again, that's just some discussion he had. That's not in any formal legislation. Derivatives and carried interest we talked on, and some estate changes that we went through that Tom talked about. Another one is what they call a mark-to-market, which would be any of your securities that you hold. In this case, he would limit it to billionaires, that those would be taxed on any just paper gains that they may have and their stock holdings. Whatever those go up in a year, they would be subject to a tax on those depreciation that they would have in a year. Large IRA balances we talked on. And then IRS audits and compliance. Again, Wyden would look to go a little further than what was in the House Ways and Means proposal. And one thing just to note, that I know that we talked about this earlier, about this $400,000 of income that they're not going to perhaps see tax increases. But if there's some additional audits, and some of those audits focus on, let's say, a partnership or an S corporation, if there's some higher income that comes from that audit, that's going to go to all those shareholders and partners. And again, that could impact taxpayers that are less than $400,000. So again, if they audit, they're not going to exclude those from any adjustments. It's going to go to all the partners or shareholders, and they could see some adjustments if they get some audit. So something to keep in mind as we see some enhanced collection efforts. So where does that leave us now? What are the next steps in Congress with this? Again, we had this House Ways and Means. The next step that they're going to have is to go to the Rules Committee. And normally the Rules Committee just kind of sets up that we're going to have the debate on the bill and what the time frame is going to be. This time is a little different. They're going to have potentially what they call like a manager amendment, where they're going to make some significant changes to this reconciliation package, including a number of tax provisions. There's already talk, Chairman Neal said that they're going to look at putting some relaxing or repeal of the SALT limitation that came about in the Tax Cut Jobs Act. There could be some other changes in it. And again, that may just be released just before they come to bring it up for a floor vote. So something to watch with it, but there could be some significant changes before the House votes on the bill. Once they do, it goes to the Senate. And the Senate, again, we just talked about, Wyden may have a different package with it. It could be similar, but difference with it once the House finishes up. One option, however, is depending if this drags out a little further, is the Senate could just decide they're just going to take the House bill, whatever passes there, and just take it directly, not make any changes. If they do make any changes, it would have to go back to the House. If they take it as is, again, they would need 50 votes to pass. And then the president has been involved, the administration has been involved in the whole process here, and trying to have their input on it. But again, they realize that with the legislative process, anything that ends up making it to the president's desk, that he would go ahead and sign that when it gets that far. Another thing, we have some observations here. One thing just to note, again, when you go under reconciliation here with a 50-50 vote, and with the current Senate being at 50-50, technically every senator is in a uniquely powerful position. Any one of them could object to it, and they could torpedo the whole bill with it. So they're in a position of perhaps more power than they normally would be, and that's part of the political process and the drama that's unfolding now in Washington. Two senators, Manchin from West Virginia and Sinema from Arizona, have expressed some reservations with it. They might eventually vote for it, but they're part of the process now because they have some concerns with certain parts of it, and they're getting a lot of the attention with it. A couple things just to note with this reconciliation that include on here is, again, there's a lot of political capital. When you go down the reconciliation route, you're invested in quite a bit politically to make sure that bill gets done. But again, you have a lot of leadership has a lot of power with this reconciliation. They control what's in the legislation, when you're going to vote on it, even what the rules are for the votes. They have a lot of ability to change the bill to get it to so where everybody's on board with it. And they also can continue to delay the process until they come to an agreement with it. So the fact that there's a lot of hurdles now, and I'm thinking, well, this $3.5 trillion might be too much. So some are speculating that it might drop down to $1 to $2 trillion, and they'll look for the lowest common denominator to try to get this passed. So the question is just to continue to follow this is, what will be in that final bill, and when will this be completed? So something just to keep an eye on with it, that while there's been a lot talked about in this last week with it, and some setbacks they may have had with it, we'll see what happens. This is what's coming down the tracks here, and as we get near the end here with it, we really have four things coming to a head here. We have the infrastructure bill we talked about that passed the Senate in mid-August. The House was promised to vote for Monday. They postponed it to today, but there's some friction between the progressive and the more moderate group within the Democratic Party with this, is to see whether this will pass or not, or even be voted on today. So something to keep an eye on with it. The reconciliation package we've talked about, there's no set date with it, but it seemed that it would probably be after the infrastructure or close to when that infrastructure bill may finally be passed. So that's something to see. The government funding, again, that runs out today, and the Senate's going to vote this morning on just a continuation till December on that, and then the House will take it up probably this afternoon, the president to sign it, so we won't have a government shutdown. But the last item in there, just to note, and this is where I think it's really going to get intriguing or complicated, is increasing the debt ceiling. That expired at the end of July, and the government, or the Treasury Department, has used some extraordinary measures to keep the government afloat the last couple months here. And Treasury Secretary Yellen has indicated that March 18th is probably about the date that they're going to run out, so that they need to get the Congress to increase that debt ceiling. And that's going to be a tall order, because the Republicans said, if you're going to do this reconciliation package, we're not going to allow that debt ceiling to pass. And again, they need 60 votes in the Senate to get there. So that's going to be interesting to see if they can work out something with it. If not, they could use reconciliation for that. But to do that, that's quite a process for them to somehow add that to the reconciliation package, add the debt ceiling with it. That could take them, several weeks just to incorporate that into the reconciliation package. So this is just summarizing some of those 4 little trains that were on there. All those things are kind of coming to a head here. So again, but I think this debt ceiling is something to keep an eye on, because that's going to get Congress's attention and may take some of their attention off this reconciliation package over the next week or two. So a lot to keep an eye on here in Congress over the next couple of weeks here. So again, we're thankful that you're all able to join us today, and we'll keep you posted as these things move forward. Tom?
Thanks, Jim. I just want to point out that, I brought up the Houston Astros earlier in the presentation. Those trains, I think they have a little train in their park that when somebody hits a home run, so it's really all come together quite well.
It does. It came full circle here. That's right.
So thanks a lot for everybody for joining us today. Hopefully, again, these are all proposals, and we're watching them closely. And then Jim pointed out some of the Senate proposals, so we'll be interested in seeing how all this comes together, or maybe not, as we may see nothing happen. So, but we think these concepts are going to stick around and be part of tax legislation proposals, either in this one or in the future. So there's a short survey that you'll receive. Please fill it out, and you will need to do that if you need CPE credit. And then the certificates will be emailed after the program within 2 weeks. And if you've asked a question that was not answered during the presentation, you have the opportunity to ask again in the survey, and we'll try to get answers to you shortly. So thank you again, and have a wonderful day.
Thank you.
Thank you. Take care.